In trading, survival isn't given. It's earned. Most CRT traders don't blow their accounts in one trade. It's slower than that. For candle range theory traders, one mistake leads to another. One failed trade creates space for another one. And before they even realize it, they're out of the game because they don't truly understand what the market is doing. Most traders think they understand CRT, but almost all of them get it wrong. And that's exactly why they lose. While CRT might seem like the kind of strategy that leads traders to consistent losses, the opposite is also true. For a professional CRT trader, one good trade leads to another. One correct decision builds momentum. And if you do everything right, you don't just survive in the market, you grow in it. But most traders never reach that point because they treat CRT like a setup instead of understanding what it really is. So, before we go any further, you need to know this. Candle range theory is not just a setup. It's a framework for survival. If you want to make this work, study CRT the right way. At its core, candle range theory or CRT is based on one simple idea: trading the range of a specific candle. To use CRT, first identify a key candle, then mark its high and its low. This becomes your range. Next, anticipate that the price will move within that range. Then execute a long position, targeting the high of the range, with your stop loss placed below the most recent low. For bullish candles, to use CRT, mark their high and low. Execute a short position targeting the low of the range, with your stop loss placed above the most recent high. Clean, simple, logical. So, the question now becomes, how do you actually know if the price respects that range? There's a very simple way to understand this. Let's take this example. Gold, 1 hour time frame. Price comes into a level and reacts. Once, twice, rejecting it both times. Now pay attention. When the price returns to that same level for the third time, a very specific type of candle forms. And this candle tells you everything you need to know. Because at this point, the market is making a decision. This is where we apply one of the simplest concepts in trading: breakout and false breakout. If a 1 hour candle breaks above the level and closes above it, that's not random. That's strength. It tells you one thing: price is likely to continue higher. But if price breaks that same level and fails, if it pushes above, then closes back below the level, it doesn't matter whether the candle is bullish or bearish. That is a false breakout. And a false breakout is not just a rejection. It's a signal. It tells you that the uptrend is likely finished, and the market is preparing to move in the opposite direction. This is the shift most traders miss because they see a breakout and they chase it. But professionals, they wait for the failure. And this is exactly where candle range theory becomes powerful. Already we know that price is in a strong resistance and supply zone, and it's likely to move lower. All you have to do is take that candle and define its range. Mark the high, mark the low, and then wait. Wait for the next 1 hour candle to close, because that close is confirmation. It tells you whether price is accepting the range or rejecting it. And once you understand that, you're no longer following price. You are predicting its next high probability move. At first glance, CRT may look simple, but in reality, if it were that easy, everyone would be profitable. This is where most traders get trapped. They follow the rules, but still lose money. Not because the strategy doesn't work, but because they misunderstand it. CRT isn't just a setup. It's built on something deeper. 3 underlying concepts. Every CRT trader should master them. Miss just one of them, and the entire setup falls apart. Let me show you what I mean. This candle looks like a perfect setup. Everything lines up, but the result? A loss. Now compare that to this one. Same strategy, same rules, but this time it delivers clean profit. So what changed? Not the market, not the setup. Before we enter this advanced section, I want you to test yourself whether you're a beginner or an experienced trader. What makes this setup fail and what makes this one work? The answer is you. You should have the right understanding of CRT's core concepts, because the real edge in CRT is not following the rules to take every clean setup. It's about reading the map correctly, exactly as it is laid out on the chart. And that brings us to the foundation behind everything you're seeing. Because at its core, candle range theory is built on one repeating cycle. It doesn't matter the market, it doesn't matter the time frame. This pattern is always there. Every move follows three phases: accumulation, manipulation, and distribution. First, accumulation. This is where price consolidates. Nothing obvious, no clear direction, just inducement, which creates the desire to enter a short or long position for every trader watching the chart. Then comes manipulation. This is where the market creates the illusion. It sweeps highs or lows, triggers traders in the wrong direction, and sets the trap. And finally, distribution, the real move, the one that actually matters. So what does this mean for you? It means that once you see accumulation, followed by manipulation, the next move is not random. It's likely to be distribution. And that is where opportunity exists. Because now, you're not guessing, you're not predicting, you're reading structure and aligning with it. And the most important part, this cycle never stops. It repeats again and again across every chart, every time frame, every market. And once you truly understand this, you stop chasing trades and start recognizing them. So now that you understand the foundation of CRT, Euro USD, 1 hour chart, price taps this level, rejects, taps it again, rejects, and then a third time. Now think about it carefully. What position would you take in this situation? See, every trader watching this consolidation phase is thinking the same thing. 3 rejections, strong resistance, price looks weak. So, naturally, most traders begin looking for shorts, and that's exactly what the market wants them to think. Because during consolidation, the market rarely shows its true intention immediately. Some traders have already entered short positions, others are still waiting for confirmation, waiting for a signal, and the moment price breaks below this level aggressively, they'll enter short as well, expecting the downtrend to continue. So many short orders accumulate here, which is known as the accumulation phase. But this is where most retail traders get trapped, because what looks like weakness is often just an inducement. The market draws sellers in early, builds conviction, creates the illusion of a clean breakdown, and then reverses violently in the opposite direction. Now you may wonder why the market maker does this. Because they need sellers. And when enough traders commit to one side, the market uses that liquidity to fuel the real move. This is where the manipulation takes place. After accumulation and manipulation, the next move is distribution, which is the true move the market maker is planning to make. In fact, from the beginning, the market maker intended to make this move. But remember, to create such a move, they need liquidity. And liquidity sits where traders place their stops. So here we have accumulation, manipulation, and distribution. Let's continue. And remember this carefully. We already mentioned that this cycle never stops. It repeats again and again, the endless cycle. What was once the distribution phase now becomes accumulation, and the process begins all over again. Now think about the traders who were trapped in the illusion of this downtrend. Now they are watching price rally aggressively upward, approaching this high. Naturally, most traders begin thinking the same way. The market is bullish. The trend is strong. Price is going even higher. So they start buying. Some enter immediately. Others wait for the breakout. But either way, buy orders begin accumulating all across this uptrend. And as price gets pushed into this high, the market creates even more inducement to go long. Confidence increases. FOMO increases, and emotional traders become fully committed to the upside. This is where manipulation takes place again, because the market is not moving randomly. It's searching for liquidity, it's engineering reactions, it's exploiting emotion. And once enough traders become committed in one direction, most of the market is long here, and naturally, their stop losses are resting below this level. The market understands that. So after enough buy orders have been activated, price gets pushed lower, not randomly, but toward the area where liquidity exists, toward the stop losses. This is the final trap. The market creates confidence to buy, encourages traders to chase the breakout, and then attacks the liquidity sitting below the range. So now the distribution phase begins. The real move unfolds. Now it's time to go deeper into CRT. Let's see how, as a CRT trader, we should actually handle situations like this. Price taps and rejects this level, and this one 3 times. It's almost like price is trapped inside a box. What does that mean? It tells us the market is entering a consolidation phase after this aggressive move. At this stage, there's no clear direction yet, just inducement, which creates the desire to enter a short or long position for every trader watching the chart. In reality, the market is simply building liquidity inside the range, Because consolidation is not random. It's the phase where the market creates uncertainty, builds conviction on both sides. Once price leaves this range with a large bearish candle, it creates even more interest in short positions. When we face a situation like this, we should try to identify a more precise range candle. To do this, we should move to a lower time frame to find the impulsive candle with a large range that leaves this consolidation phase, which is this candle on the 5-minute chart. This is our range candle. Now mark its high and low, and wait for the next candles. At the next step, anticipate that price will continue reacting within this range, and to understand whether the market truly intends to leave the range, we apply the breakout and false breakout concept. Now here, a breakout is technically visible. But notice something important. Price only breaks the level by 1, maybe 2 pips. That is not enough. Because in CRT, we are not looking for weak breaks. We are looking for clear acceptance outside the range. A true breakout should show conviction, strong displacement, strong candle closes, not hesitation. So instead of reacting immediately, we stay patient and we wait for the next candles to reveal intent. Because the reaction after the breakout often tells us more than the breakout itself. If price fails to continue, if candles begin rejecting the move, then what looked like a breakout may actually be manipulation. So, by the close of the next candle, we can now observe that this move was not a true breakout at all. It was simply a manipulation phase, designed to trap traders on the wrong side of the market. The breakout failed, price rejected the move, and the original range remains respected. That changes the entire perspective. Now, instead of looking for shorts, we begin preparing for longs. So the next step is clear. Execute a long position, targeting the high of the range with the stop loss placed below the most recent low. But now the important question becomes, how do we actually enter the trade with precision? Because professional CRT trading is not just about direction, it's about execution. And this is where lower time frame analysis becomes critical. To refine the entry, we can drop to even lower time frames and search for precise confirmation, usually in the form of an order block or a fair value gap. These areas help us identify where the market is likely to rebalance price before continuing toward the true move. And once price reacts from one of these zones with confirmation, that's where the high probability CRT entry appears. Now, here on the 1-minute chart, we can identify a very clear fair value gap entry. And honestly, that's all we need. A clean confirmation, a precise entry, and a defined range. That alone is enough to capture this 20-pip move with precision. And this is the difference between reacting emotionally to the market and understanding how to read it through CRT. So, guys, that's it for today. This was the first part of this CRT education series. In the next video, we'll continue breaking down more examples, including the entry method, advanced concepts, and the deeper knowledge needed to truly understand candle range theory.